Hello and welcome to our discussion on accounting. In this session, we'll use this data given here to prepare the financial statements and then also use this information to find the economic value added. But if you see this data given here, it is saying the financial items as on 31st March 2011. So this information, financial item, has to be converted into financial statements or balance sheet as the opening balance sheet, and then we'll use the transactions to prepare the financial statements. So let us see the information given here and convert or create the opening balance sheet. So the capital is 100,000, reserves not given, 10% loan 100,000, creditors 25,000, and 6% loan is not there. Cash is 300,000, receivable 30,000, stock or inventories 100,000, shares of X is an asset, plant is an asset, intangible assets 50,000. So the summation of these assets given is equal to how much will be that is 610,000. Then the summation of the sources given is summation of this is 325,000. So the balancing figure is 285,000 will be treated as reserves, 285,000. So with this opening balance sheet, we'll now prepare the financial statements using the transactions given here under. So the transactions are purchase stock for cash 150,000. So the opening cash in hand is 300,000. Purchase stock for cash 150,000. The stock will increase to that extent, 150,000. Raised loan, we raised loan on 1st October, 300,000. So the loan is a source and receipt. Sold 50% of the stock, so sales is 500,000. It is not for cash, so the receivable will go up to the extent of the credit sale, which is 500,000. Collection from old debtors 70,000, so collection is an inflow of cash. The 70% of the old debtors collected, so as a result the receivable will further go down to the extent of 21,000. Rent per month is 3,000 and rent paid is 72,000, so the rent payment is 72,000, whereas the rent for the period is 36,000. So there is an advance rent. If the payment is more than the expense, it is treated an unexpired item and that is treated as an asset. Receive dividend from X, so dividend is an income and dividend is a receipt. Dividend is a receipt, 20,000. Payment advertisement, 15% of sales is an expense and sales is 500,000 into 15%. and the entire advertisement we assume that has been paid during this period. So advertisement is an expense and a cash outflow. Payment to the creditor 80%. Payment to the creditor. Payment to the creditors 80%. Old creditor, so 0.80. And the creditors in the process will reduce to the extent of 20,000. So all the transactions done except the dividend and the tax. So let us find the profit, but before that let us charge the interest. So interest on loan, 10% of the loan, and interest on 6% loan for half year, because it's been taken in the middle of the year. So therefore interest will be 6% on the loan for 6 months, and the entire interest is assumed to be paid during the period, so 29,000 paid. Since all expenses have been recorded, all incomes have been recorded, we'll find the profit, summation of incomes, summation of expenses will give us the profit before tax. We assume that the accounting profit is same as the tax profit, and we calculate the tax on the accounting profit is charging 20%, and tax is an outflow of cash too. So the profit after tax is 380 minus tax, 304,000, and we transfer that to the reserves. However, during the period there is a dividend distribution of 150% of capital. So therefore the dividend is 150,000, and the reserves will go down to the extent of 150. So let us see the change in the reserves. The reserves have changed because of the current profit, 304 minus the distribution of dividend. So opening reserve plus PAT minus closing reserve minus the dividend is the closing reserve. Since all the items on the income statement done, we can find the cash in hand. Cash in hand is a cash available minus the cash payments. Cash available is 570, so for 641 minus 572, so cash in hand is 69,000. Since cash flow statement done, income statement done, we'll close the balance sheet. No change in the capital, no change in the loan. The summation of sources should be equal to the summation of the assets. No change in the plant, no change in the intangible. So there is no depreciation or amortization given here. So we calculated the profit ignoring the depreciation and amortization. So the balance sheet, income statement, cash flow statement done. But this cash flow statement shows all receipts and payments. We would like to find cash from operation, cash from financing, and cash from investment. Cash from financing is a loan raised minus the interest minus the dividend. Is a cash from financing decision. Is a loan raised minus interest minus dividend is the cash flow from financing. Cash flow from investment, in this case that is only dividend received, no purchase of assets, investments. So the cash from investment is a positive 20,000, and cash flow from operation is a collection minus the purchase of stock minus rent minus advertisement minus the payment to the creditor and minus the payment towards the tax. So the CFO is a negative 372,000, which is collection minus stock minus rent minus advertisement minus creditor and minus tax. So CFO is equal to 372,000. The summation of cash CFO, CFI and CFF is equal to cash in hand, which is 69,000. That takes us to the second question. The another question related issue is when the PAT is 304,000, why the CFO is negative 372,000? So that can be answered by reconciling CFO with the PAT. We know that PAT is not equal to CFO because of the non-operating, because of the non-cash items and credit items, which are also called the changes in the operating working capital. So the dividend is a non-operating income. We deduct that from the PAT. Interest is a non-operating expense. We treat that as a financing expense, so we add it back. Then we'll see the changes in the working capital. The changes in a working capital in this case is because of the creditors. Creditors have been the decrease in creditor. So decrease in creditor is an outflow of cash. Then we'll see the stock, the increase in stock, that means an outflow of cash in the form of purchase. The receivables has increased, that means huge credit sales, so will be treated as a reduction. And advance rent has been paid during the period, so there is an outflow of cash. So the summation of the PAT and with the adjustment should give us the CFO. So CFO is negative because of the, despite having positive PAT, because of huge credit sales. So change in the receivable, which is minus 479. Now after completing this GAAP driven financial statements, let us calculate some non-GAAP items, and one of them is the net operating profit after tax and before interest, popularly known as NOPAT. So NOPAT is equal to add interest into 1 minus T. That means add interest less tax benefits of interest. So the interest is 20,000 plus 9,000 into 0.70, that is 1 minus T. So PAT is not equal to no PAT here because of the financing charges. So we remove the financing charge since we assume that there are no other accounting adjustments. So no PAT is equal to PAT plus interest into 1 minus T. Then we can find the capital employed. Capital employed is the equity plus the debt, interest bearing liabilities, and that is equity plus long-term loans and the short-term loans respectively. And we have taken the closing balance, so therefore the equity is 539,000, loan is 200,000, and 6% loan, we only taken half of it because the interest, the loan was taken at in the middle of the year, so has been used for half of the year only. The corresponding cost of these equity costs, the cost of equity is been calculated because the information about RF, beta and RM is given, so we can calculate the cost of equity by using the CAPM model, that KE is equal to RF plus beta into RM minus RF. So using that, we got the cost of equity as 18%. The cost of debt is a coupon rate of interest into 1 minus T, so 8%, and cost of 6% loan is a coupon rate of interest into 1 minus T, which is 4.8%. So the summation of all these three sources will give us the capital charge. So capital charge is the cost of equity plus the cost of interest bearing liabilities. So economic value added, we know that as a NOPAT minus the capital charge. So EVA is equal to NOPAT, which is 324,300, minus the capital charge, which is 120,220. So EVA is equal to 204,080, and EVA has been calculated by adjusting the PAT with the interest and post-tax interest and deducting the capital charge from the NOPAT. So NOPAT is 204,080. So with the information given here, we can say that the firm is having accounting profit 304,000, but the firm is not able to create the cash flow from operation, so it is negative. But the firm is also making an economic value added or a positive EVA. That means it is generating wealth for the shareholder. However, the concern is about the CFO or negative CFO. A significant amount of the cash flows are in the form of negative CFO. Thank you very much.